Seeds of Wisdom RV and Economics Updates Tuesday afternoon the 9th of July 24. Listen to the full version on the official dinarreport.com website and become our supporter on Patreon. Russia, one of the leading nations in the world, has now added one more feather to its cap. The nation's GDP has reportedly exploded post-sanctions. Russia is now one of the most prosperous nations in the world, with its per capita income ranging from $14,250 annually. The nation is also spearheading efforts to derail the US dollar by echoing the multipolar currency narrative. It is particularly interesting to note, considering that the US has sanctioned Russia by cutting its access to the SWIFT payment system. Despite encountering a major financial blow, the Russian economy is projecting an upward ascent, displaying its mettle against global nations. Russia is exclusively heading the de-dollarization agenda. Being an active part of the BRICS alliance, the nation, alongside China, India, Brazil, and South Africa, is currently planning to launch an independent currency system rivaling the USD's prestige. At the same time, Russia is also conducting active trade proceedings with China in local currency, ditching USD usage in every possible way. BRICS duplicating the Bretton Woods structure? Jim Rickards. Notice what the BRICS are doing. They copied the World Bank and the IMF. They are duplicating the Bretton Woods structure. They're also building underseas, fiber optics, telecom channels so they can bypass channels like SWIFT and others that are controlled by the West. BRICS has been building this infrastructure for 15 years. SAB 121 set for veto vote on Wednesday. The U.S. House of Representatives is scheduled to vote on significant crypto legislation on Wednesday, July 10th. The U.S. House of Representatives is scheduled to vote on significant crypto legislation on Wednesday, July 10th. This vote might override President Joe Biden's veto of the Securities and Exchange Commission's (SEC) resolution to repeal Staff Accounting Bulletin 121, SAB 121. The SEC issued SAB 121 in 2022, which mandates that banks holding cryptocurrency must disclose these assets as liabilities on their balance sheets. Many in the crypto industry have questioned this accounting treatment, claiming that the additional regulatory burden deters banks and other institutional actors from dealing with digital assets. Ron Hammond of the Blockchain Association highlighted the unusual political dynamics at play, noting that crypto has now found itself to be a campaign issue. Bitcoin ETFs gaining acceptance in Australia. Australia's leading stock exchange, the Australian Securities Exchange, ASX, has approved listing the second Bitcoin exchange-traded fund, ETF, on its platform. On July 9th, the ASX gave the green light to digital asset manager DigitalX to launch a spot Bitcoin ETF. The new ETF will begin trading on July 12th under the ticker BTXX. The flurry of new Bitcoin investment vehicles hitting the Australian market reflects the growing interest in Bitcoin exposure. Investors are increasingly looking to gain Bitcoin exposure through regulated fund structures rather than direct ownership. ETFs provide an easy avenue to invest in the asset class without needing to custody Bitcoin directly. Many expect more countries to approve Bitcoin ETFs as the instruments gain traction and regulatory acceptance expands. By greenlighting another Bitcoin ETF, Australia's main securities exchange demonstrates a favorable shift in attitudes toward Bitcoin assets within one of the world's top financial markets. We're seeing Europe joining in with China and the East linking wholesale CBDCs. The Banque de France, BDF, has signed a memorandum of understanding with the Hong Kong Monetary Authority, HKMA, to explore how their differing infrastructures can support cross-border settlement. Using wholesale central bank digital currencies, WCBDCs, building on their mutual participation in the European Central Bank's ECB, Eurosystem CBDC exploratory project. The testing will focus on real-time cross-border and cross-currency payments, according to the central bank, and will explore the optimization of settlement efficiency by strengthening the compatibility of financial market infrastructures between different jurisdictions. From this month up until November, the group will be tasked with exploring the mock settlement of domestic payments, foreign exchange (PVP) transactions, and a wide set of securities-related use cases, as per the ECB's June announcement. Global race for crypto regulation speeding up. HK maturing, Singapore cautious, Dubai pragmatic, EU comprehensive, US promising. There has been a marked recognition amongst global regulators that to build the guardrails to protect investors, we must collaborate. And policymakers have listened, supported and reacted. Hong Kong advances crypto regulation with strategic developments. Over the last 12 months, Hong Kong has pushed forward a raft of regulatory announcements in a bid to develop a tightly regulated home for the digital asset industry. From implementing a licensing regime for virtual asset trading platforms, to working on a framework for fiat-referenced stablecoins. A major milestone was reached with the introduction of Bitcoin and Ether ETFs. In December 2023, the Securities and Futures Commission, alongside Hong Kong's Monetary Authority, HKMA, released a joint statement in which they detailed the requirements that must be met for the regulator to approve ETFs with more than 10% of holdings in crypto. Within 4 months of this circular, spot crypto investment products in Hong Kong received the green light. Singapore strengthens crypto ecosystem with robust regulations. Meanwhile, Singapore continues to enhance its regulatory framework for cryptocurrencies. While cryptocurrency trading and possession are legal, the Monetary Authority of Singapore, MAS, maintains a cautious approach, particularly concerning the public advertisement of crypto services. Against this regulatory backdrop, Singapore is spearheading forward-thinking initiatives like Project Guardian. This project, a distinct yet complementary approach to Hong Kong's EHKD program, also explores blockchain's potential across different financial sectors and demonstrates how tokenization can significantly enhance market and transaction efficiencies. Dubai attracts crypto firms with a defined regulatory framework. The UAE has signaled its intent to become a global hub for the sector by outlining clear guidelines for firms looking to operate in the region. In 2022, Dubai established the world's first independent regulator for virtual assets, the Virtual Assets Regulatory Authority, VARA, to serve as a transparent and trusted guiding authority for the emerging world of crypto. Firms operating in the cryptocurrency space in the UAE must obtain a license from the Securities and Commodities Authority, ensuring they meet the required AML and Know Your Customer standards. Europe presents unified approach through MiCA. Europe has taken a proactive stance with the introduction of the Markets in Crypto Assets, MiCA, regulation. Europe has taken a proactive stance with the introduction of the Markets in Crypto Assets, MiCA, regulation. This comprehensive framework is the first of its kind globally. The crypto measures aim to create a unified regulatory landscape across 27 countries in the EU, ensuring consumer protection, facilitating legal certainty for businesses and attracting more investment to the region. Promise of progress in the United States. In the United States, the recent passage of the Financial Innovation and Technology for the 21st Century Act, FIT 21, by the U.S. House of Representatives is a landmark development. After large industry players quit the country due to regulatory crackdown and uncertainties that have made investments in the U.S. higher risk, FIT 21 aims to clarify the regulatory responsibilities of the Securities and Exchange Commission, SEC, and Commodity Futures Trading Commission over digital assets and update existing securities and commodity laws to accommodate blockchain technology applications, including decentralized protocols. It categorizes digital assets into restricted digital assets, digital commodities, and permitted payment stablecoins, each with distinct regulatory oversight. Why is tokenization of trade finance transformative for investors? Standard Chartered and Synpulse paper explains why digital assets are critical to addressing financing requirements of companies. Institutional investors are always looking for new, fast-growing markets. Trade finance tokenization provides exposure to emerging market assets. For banks, tokenization can help raise their net interest income and optimize their capital structure. Standard Chartered Bank's new paper titled Real-World Asset Tokenization, a Game Changer for Global Trade, written in collaboration with global consulting company Synpulse, gives some insights into tokenization of trade finance. Tokenization is the process of issuing digital representations of real or traditional assets in the form of a token on a distributed ledger which can be fractionalized into smaller and transferable units. Quote, This ability to produce bite-sized assets for ownership is a game-changer for asset classes that are struggling to secure funding and liquidity. Tokenization could support companies in need of trade financing by opening a viable channel for institutional investors such as asset management companies and sovereign wealth funds to provide capital. MMEs are especially active in fast-developing regions such as the Middle East, Asia, and Africa. They represent a vast and largely unaddressed market, offering an immense yet unrecognized opportunity for investors. Banks stand to gain from increased tokenization of trade finance assets as well. With the increased pressure to comply with Basel IV requirements by 2025 on the calculation of risk-weighted assets, banks need to be strategic with their balance sheets and the emerging digital asset markets, thereby providing companies in need of trade financing access to a global pool of institutional investors seeking returns. Through tokenization, banks can adopt an originate-to-distribute model for trade finance by distributing trade finance instruments they have initially financed to the capital markets. Learn more about the role of banks in the tokenization of trade finance and how the tokenization of trade finance is a win-win for both banks and institutional investors globally by reading the entire article and PDF below. Listen to the full version on the official dinarreport.com website and become our supporter on Patreon. Source: Dinar Recaps.